guys, welcome back to the Capital Mindset Show. Today's one of those conceptual videos. So for those of you who may not have seen more recent videos, there's going to be a couple of changes to the channel format. So basically, we're going to have the subscriber request series, and that's going to be coming out. At least I'll try to do one a day here to the end of time, as long as Capital Mindset's around. And then we're going to have also these conceptual videos where we tackle very profound topics. Today's topic is going to be one that a couple of you have requested in one of the other videos that I have done. And I promise you, if you stick to the end, it's going to be actually quite mind-blowing. I'll warn you, there is a bit of math when we get towards the end of the video, but it's more or less for you guys to follow along. For those of you who are not watching visually, I'll try to be as descriptive as possible. And, you know, just in case, but because I want this video to actually serve a wider audience. So some people may be, you know, driving, so you won't have to actually see what's going on, and I'll try to be as descriptive as possible. All right. So this video in particular, if you guys might have read the title, it's going to be concerning ETFs, the index funds industry, etc., and some of the benefits. And then we're going to talk about some of the drawbacks, because everything has drawbacks. So I guess before we begin, and I'll warn you, it's not going to be a presentation. I just have a little mini presentation towards the beginning. It's going to help me kind of color some of the benefits and some visuals, but don't worry, this is not a PowerPoint presentation video or anything like that. We'll never do those kinds of things. All right, so the beginning, we're just going to go over real quick, index funds. All right, so I'm not going to really go over exactly what an index fund is. We're going to go into the structure, and more or less that will be discussed in more detail. But for the most part, I think my audience knows what an index fund is. So first things first, let's talk about some of the benefits. So the number one benefit is psychology, right? So right in front of you, there's a chart showing the average investor being dead last in terms of investing performance. And this is from the years 1999 to 2018. The average investor has performed about 1.9%, with the different asset classes listed before or in front of the average investor. REITs have been doing the best. That deserves its own video. And don't worry, that one's going to have a sector analysis video that will be coming. Gold's performed about 7.7%. Oil's been 7%. S&P 500 has been about 5.6%. And keep in mind, this is up to 2018. So be careful with those years. This is from JP Morgan Asset Management, the presentation that they provide, the data they've collected. And so the S&P 500 from 1999 to 2018, that time frame has performed about 5.6%. And then the 60-40 portfolio, about 5.2%. The 40-60 portfolio, about 5.0%. Bonds, 4.5%, et cetera. All right. So the point of this is the psychology aspect of investing, the probability that the average retail investor will have the fortitude to hold through drawdowns and have conviction in certain investments is quite low. And the reason why I'm mentioning that is a lot of the bad investment performance can be attributed to basically bad timing. People can't really time the market. They think they can. They think they're, you know, the next genius, the next Warren Buffett. And unfortunately, it doesn't work out that way. As well as retail investors usually tend to make up what we call the average investor. And usually during the bubbles, right, during the big bubble periods, they're the ones who are actually buying it at the top, statistically speaking. So of course, statistically speaking, they're going to perform the worst. Okay. Now, there are some caveats to that, but for the most part, this is what we're discussing with the realm of psychology. ETFs or index funds allow the average investor to kind of mitigate those psychological trauma, as we can call it. So if you see your stocks go down about 40%, I think today, as of filming, it's 1/21/2022. Netflix is down quite a bit, and there's a lot of people potentially selling there. We know there's a lot of different micro caps or mid caps that are not profitable yet, and they're selling off hard. The ARK funds, a lot of companies put in the ARK fund are selling off hard. So we are seeing a lot of investor sentiment turn negative for these investments. And again, you got to keep in mind who's invested in those things, primarily retail investors. Okay. So next thing of the benefits is, of course, the cost. Again, some of these things may have been repeated to you. Again, stick to the end to see like a lot of the really nitty gritty stuff. But So the cost of index funds has been beneficial to the average investor. And you can see right in front of you, the average fund, a lot of the actual gains actually go towards the fund managers. So over time, this eats away at the returns of the average investor invested in these funds. And so index funds are low cost, and therefore a lot of the benefits remain with that investor. So low cost index fund strategy has been preached by people like Jack Bogle. And so he's been saying for a long time, you own the market. He created the Vanguard, and he was one of the founders. And through that, he's tried to help a lot of the average people get exposure to the market in a low cost way. Okay. And then the last benefit, of course, it's very easy. You know, it doesn't take any effort to go out and buy the SPY or VOO, VT, VTI. These are just some I'm throwing off as an example. But then we'll get to some concerns, because I guess that's what people wanted this video to be made about. And I want to say that I think the benefits outweigh the concerns, but the concerns are there. And as some of you may know, I have no index funds in my portfolio, but that's for me and that's my personal journey. That doesn't mean you should do that. So let's first talk about, for example, the dominance of what we call dumb money. And this is kind of a phenomena that I'm observing, and these are basically my opinions being expressed. This image was drawn out to show the positiveness of it, how investors are switching over to a more passive investing approach. Not that I agree with active investment like mutual funds and stuff like that. I don't actually think that that's the best way to invest. I don't have any of my money in mutual funds. I have no one managing my own money. So just to give you an idea. But actively managed funds, they've been reducing and reducing and reducing, and passive funds have been increasing. This data is out of date. It's actually more than that now. And we are approaching the 50% mark, actually. And so as we cross the threshold of what I call, smart money, it's not really smart money, but, for the lack of a better term, smart money, meaning individuals are moving the money. This in turn switches the market to be dominated by what we call dumb money. And dumb money, when in the vernacular, all it simply means is there's a preset, you could call it algorithm, you could call it a set of rules that buy and sell based on these preset rules, right? And you can already start to see where some problems occur, but I actually think this is a huge benefit. So one of the things I'll say here on the internet now, but those in my inner circle, those close to me, those at work, know that I've been saying for quite a long time that the index in ETFization, that's the word I use, ETFization of the market is to the benefit of the investor, the individual investor, longer term. And the reason why I say that is because we can take advantage of the drawdowns that are going to be caused by the ETFization. So for example, things are getting more and more tied together. And so in theory, according to my theory back then, and I started having this theory about 2017, and then 2018 came along, and I kind of was like, I think I'm kind of right on that. I still think I'm not 100% right, but I have more confidence that I'm going to publicly say here on the internet. And that is, as everything gets tied together, right, through the ETFs and the way the ETFs are designed, which we'll get to just in a moment, the drawdowns in theory should be greater, and then the rises should be sharper, right? So in periods of volatility, there's going to be a lot of opportunities to be had for the individual stock picker easier said than done, if that individual stock picker can pick the proper investments. Easier said than done, like I said. Okay, so while I think that the dominance of dumb money, some people say, oh, it's Armageddon, blah, blah, blah. No, I actually think it's a really good thing for those who are the individual investors. Before, it was a little more difficult, I think, because you had a lot of people looking for those same deals. As those people leave, you always want to not follow the crowd. It was to the benefit, this is again my thought, it was to the benefit of passive investors in the past, because you allowed the market itself to kind of dictate where capital should be allocated. And then this goes into how they're designed. Okay, so the way all these index funds are basically designed, and this is the grand majority of them, okay, so majority of them are organized this way, is that they are market cap weighted. Okay, and we'll discuss exactly what that means right now, and then I'll kind of talk about what some of the problems you guys might be thinking may arise from a market cap weighted strategy. All right, so essentially what it means is the larger the stock, the more it will add, okay? So remember that in the past, the dominance of the market was by individual investors, by what we call, again, for using the word, smart money. And so the passive investment strategy was simply that the market would dictate where capital would be allocated best, and then you should just follow the market, right? But now what happens when you become the marginal buyer? When dumb money becomes the marginal buyer, things get a little bit interesting on that strategy, right? So that's some of the concerns you may think about. But anyway, for the most part, you can kind of see here, as Apple grows, right, the more it buys. So the more Apple grows in stock price, the more the index will buy, the more. And then for those of you who've been watching the channel for a long time, you know that the mechanism for how stocks go up in the short term is simply more buying than selling, right? It's the amount of buyers versus the amount of sellers, or the amount of buy orders versus the amount of sell orders. And again, if the stock price keeps going up, right, what will there be more of from the index funds? More buy orders, right? So it's a self-fulfilling loop-de-loop process, which is rather interesting. And then in the opposite direction, if things start to sell off, it can accelerate the sell-off, right? So if certain sectors sell off, they can sell off harder than before. So it kind of, again, goes back to what I was saying before. I think there's going to be sharper drops and quicker rises, right? And I hope those of you watching probably have been observing that, right? Since about 2018, when the majority of the money started to slowly become dominated by index funds, you can kind of start to see that happening in the market. And I think this is a good thing for the individual stock picker, not a bad thing. This is a very good thing. It's actually, in my opinion, going to be easier and easier and easier if this continues. And it's always kind of like that philosophy where you want to go against the crowd. So in the past, everyone, the crowd per se, was the active management. And so the going against the crowd mentality was actually passive investing. Now that the crowd is the passive investing crowd, right? That is the crowd. Going against them is actually trying to be that active manager, right? For yourself. But that doesn't mean it's for everyone, but I'm just giving you kind of like a philosophy of it. All right. So that's basically how most of them are designed. You have some, like ARC, Innovation Fund, stuff like that, where those are basically stock picked. It's a stock picked ETF. And then it has some rules on weightings, right? But they have preset rules, some preset rules. But for the most part, I'm trying to give you a broad brush on some index funds. Okay. So with that being said, I think we'll get into the crux of some other issues that may arise from index funds that you may never have thought of or been told about. All right. So the first thing I'll do is I'll actually showcase a presentation by Yahoo, right? And I know, so it's a stock market briefing presentation. And here we go. So I want everyone to remember this number. Okay. So the number I want you to remember is 20.8. Okay. So S&P 500, 20.8. Okay. So it's around there. It's around 20 something. And this is fairly recent. Okay. So from here, again, please memorize that number and don't forget that number. We're going to come back to this. We're going to go to now a little bit of the breakdown of the meta, right? So I want to walk you through. I have to be careful how I walk you guys through this, but for the most part, should be fairly easy. And again, I'll try to be as descriptive as possible for those of you who are listening to audio only. So here before you, I recreated a model portfolio, model ETF. For those of you who may see, yes, there's Tattooed Chef in there. Yes, there's Corsair in there. Those are kind of just shout outs, right? All right. So anyway, the point here is we have Apple, Tesla, Microsoft, Google, Amazon, Tattooed Chef, and Corsair. Okay. Simply put, in year zero, these are the years up here. In year zero, we're going to take the market cap, right, of each company. And that's right here. Boom, 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 boom. All right. We add them all up together, right there. Okay. So in this example, okay, we're going to apply some random growth rates. And I literally just did it randomly. And I can change this if you want. So like, I'll change that back to 50. And there's a reason why I did that. It's for the presentation for an example. But right now, let's assume these are the growth rates. And I made them all positive because I didn't want to make any negative. Of course, some of those might be negative, but for the most part, they're all positive. And I wanted to showcase something. So Down here, it's important to note the totality of the market caps, right? Because this is how, again, we're going to design our ETFs. The rules are that it's a market cap weighted ETF, right? So basically in year zero, the weightings are as follows. Apple is 41.7%. Tesla is 14.92%. Microsoft is 34.99%. Google 27, Amazon 22, Tattooed Chef is 0.02%. Coursera is 0.03%. Okay, so this is our little ETF. And as the growth rates are applied by each and every single year, we see that the weightings change, right? Because some grow more than others, right? So again, the theory is that if you're doing a market cap weighting, you're going to adjust to those that are the market is allocating more capital to. And this is the passive investing approach, right? This is how all of them are designed. This is how VT is designed, VTI is designed, VOO is designed, all of them. Very simple, right? And you might then think, okay, well, if the rules were designed by humans, there's some flaws in them. It's like, yes. And then we'll kind of get a little bit more to that. So let me actually look to see in the sheet because I wanted to hide something from you guys and then kind of pull it up as a surprise. Yeah. Okay. Now it's hidden. All right. I almost spoiled something. All right. So now we're going to look at the PE concept, right? I know that in this channel, I've spoken about how GAAP net income, you got to kind of be careful with that, but we're going off the industry average. And remember, we're comparing it to that number we saw in Yahoo. And hopefully you guys remember that number. It's about, I'll say it out loud. It's about 20 something. So right here, we're taking the PE, and logically how normally you use math to calculate the PE of something is by taking the weighted average PE. That's logically how you would do it. So you say, okay, if something is 20% of the index, it should contribute 20% of the PE, right? That's kind of like the logic, right? And that's how I would do it. That's how most people who know math, when I asked my brother, who is a mathematician, he said that's how he would do it. Yeah, it makes sense, right? Of course, you want to maybe sometimes eliminate anomalies, but for the most part, not really. You want to actually, if you want a real representation of what it is, there you go. And the reason why you want to eliminate some anomalies, let me explain that, because some of you may be like, what? The reason why is, some accounting discrepancies might change one-time things, et cetera. So sometimes you want to eliminate those anomalies because you just so happen to eliminate those. Okay. But the point is, we would do a weighted average PE, and that would give us about 88.96 for our portfolio. Because the PE is right here, you can see Apple, Tesla, of course. At Tesla being a 14.92% gives us a huge skew on our PE, right? So it's probably shifting us a lot. But even then, we have a lot of companies in here with very high PEs. And I just took what Google says is their PE. Okay. This is not an analysis video, so I'm not going to dive deep into the numbers. This is taking the PE and we're trying to come up with an example. Okay. What if I told you this is not how they calculate the PE on index funds? I'll let that sink in 2 seconds. 1, 2. Okay. So yes, this is not how they calculate the PE ratios of index funds. Okay. I promise you, this is now where the math starts to get interesting. So what we have is, and you can see down here in the title, it's the harmonic average. Okay. This is how we collect the PE of index funds. Okay. When I say we, it's not me. I don't do it. Those who work in the finance industry who design these products, this is how they more or less do it. All right. So, and we'll get to the real world example of, we will calculate together the harmonic average PE of the S&P 500. But first, I'm going to explain to you how to calculate the harmonic average. And then you're going to probably, I don't know, some of you, your heads might explode because you'll be like, that makes no sense. Why do they do that? Okay, we'll explain. All right, so here's what I was trying to hide from you. There's no rule 3. I was going to write a rule 3, but there's no rule 3. So rule 1, no negative PEs. You eliminate those. Those are gone. Okay, so all the unprofitable, crappy companies, they're gone. Okay, rule number 2, no PEs over 100. For the sake of this example, I will not eliminate those. I will keep them in. I will use that in the real world example. I will eliminate the negatives and the PEs over 100. I'll filter them out and I'll show you how I did that. All right. Anyways, for now, we're looking at the model ETF that I created just randomly. And by the way, I can switch whatever we want. Like I can say, okay, let's say we don't want Tattooed Chef. Let's say we want Visa. So, oh, didn't mean to do that. Visa. Oh, no, not Ver, just Visa. Or am I changing the wrong one? I am changing the wrong one. Let's actually escape. There we go. Okay, we don't want to change that one. These are the ones I want to change because those are all connected. All right, so now I just change it to Visa and everything should be changing to Visa. The weighting's cool. All right, yeah, so everything's good. The weightings are good. All right. So now the PE has changed in accordance to that. It's a little bit about the same because it just got rid of a 60 and basically put a Visa, and Visa's been more in line, so it barely changed the P. All right, but anyway, what you're here for, I just wanted to say I could change it, but you know, there you go, a little fancy magic. All right, so the way we calculate the harmonic average is actually quite interesting. So first you take the PE, the standard PE, you have your weightings, right? We don't care about those just yet, okay? So we take the reciprocal, okay, of the PE. The reciprocal in mathematics is simply 1 divided by the number that you're talking about. So the reciprocal of 28.95 is 1 divided by 28.95. And this gives you this number right here. So you see the formula, very simple, right? You get 0.034. All right, then you add all these together and you get the sum. You get the total sum, okay? Now, this one, I did this for as an example. So this is actually wrong. I need to do 1, 2, 3, 4, 5, 6, 7. So there's 7. So this one should be 7. And then we calculate it together. Okay. So now here, I'll explain how we got there, but you divide it by the number of stocks in your little ETF. And that's 7 in this case. So that's why we put 7. So you divide again. Let me say that again. You sum up the reciprocals, right? What is a reciprocal? A reciprocal is the number you're talking about. And then you do 1 divided by that number, right? Then you sum up those reciprocals, you get the total sum, and then you divide by how many stocks are in your ETF. And then you get that's what we call the average reciprocal, okay? So you divide the sum by the quantity, and then you get the sum or the average reciprocal, right? And then from there, you get the reciprocal of the average reciprocal, okay? And the reciprocal of the average reciprocal is 33.9. Okay, so this is the PE that we'll show everyone. This is welcome to the finance industry. So yeah, this is the PE that we'll tell everyone is the PE of our little ETF, not 86. Okay, because 33 sounds nicer. And technically, we did a bunch of fancy math to get there. Okay, and remember, we follow a couple rules: no negative P's and no P's over 100. I broke that rule here. Technically, I wouldn't even include Tesla's PE into the ETF. Wouldn't do it. Okay. Okay. So now remember that number that we discussed, the 20 something from Yahoo or whatever. So now we're going to discover what the S&P 500 is. All right. So I'm going to try, and I'm going to pause here because I want to hide the number so we can kind of guess. Actually, I won't even pause. Let's just go through it. And so you guys can just see. There's no point in suspense. All right, so here we're on the final sheet, and spoiler alert, the answer is exactly what they're showing you. All right, so I already went over how you calculate this. I just did it for every single stock in the S&P 500, filtered out, you know, the negatives and the ones over 100. Eventually ended up with this, divided it by the number of stocks in the S&P 500. I got exactly what they offer you. There you go. That's how they do it. This is what, you know, some might argue it should be. It should be 36 because that's the weighted average PE. So, you know, without the fancy schmancy math, I do believe there are some websites that do it this way. It's just when you see, like, for example, representations like this, you'll get this. Okay. Yeah. Okay. So if you guys have any questions on this concept, feel free to leave a comment down below asking me a question. I know that today, yeah, it's changing in real time, by the way. So if you saw it move, it's okay. So if you guys have any questions about this, feel free to leave a comment down below. And I know this is a kind of a heavy topic. Basically, I hope I kind of covered the designs of ETFs, how they're designed, some of the problems, right? Because was the main focus of this video. And then not to say that ETFs are terrible and you shouldn't think about them, but just to show you it's not all sunshine and rainbows with index funds. There is a darker side to index funds. And specifically, you can kind of think of it as They are a financial product designed to make profits, right? So of course there's going to be, something, there's going to be a giveaway. There's no such thing as in this world, something so easy, it's just like a press a button and you go, right? They are a fantastic way to get exposure to investing. That is very true. They're, again, remember the benefits. They help you with your psychology of investing. They are low cost relative to traditional means. You may want to take my theory with a grain of salt because it's just simply my theory as to what will happen going forward, and let me be the experiment, I guess, to that theory as far as what that means for market fluctuations. And just basically, I would highlight again the concentration of a lot of these ETFs. They're fairly concentrated. And I think actually I should discuss this. Most actively managed funds have rules on them. And we're not talking about hedge funds. We're talking about ones that the average investor can actually invest in. There's limitations on the concentration they can have. And if one thing that you find interesting is when you look at the concentration levels of a lot of these index funds, they're actually beyond the concentration even allowed by those actively managed funds. So it's kind of interesting because the regulatory bodies that be, they believe that high concentration equals risk. But if you're actively managed, you're subject to those rules, in which case you cannot be highly concentrated, and that actually may hinder performance. Because I can guarantee you, if you told me I had to invest in 200 companies, I'm going to pick a ton of terrible ones. There's only so many. It's like kind of like Buffett says, you have a punch card. There's only so many out there that are really actually interesting at any given moment. So the other thing is the index funds themselves, they're not really subject to those same rules. And you'll see actually a lot that are far more concentrated than what those actively managed funds are allowed to be. All right. That's not to say active managed funds are good. It's just to point out yet another disadvantage that they do have because they're not allowed to. But I hope I explained at the beginning, what's the benefits of index funds. I hope I also explained well that index funds, for example, over the past, what their strategy was in the form of passive investing and why that was perhaps the best way to do it because it was against the crowds. I hope I explained well what it means to be a weighted average, or not a weighted average, market cap weighted index, meaning the larger something gets, the more it will add sometimes. And then when the more it adds, the more valuable or the higher the market cap it becomes, and it becomes a self-fulfilling loop-de-loop. And then this kind of happens with the etfization of the entire market again, because you have multiple ETFs kind of overlapping each other and they're kind of fulfilling the same thing. So then my theory goes that going forward in the modern era, we're going to see higher, more rapid drops and more rapid rises. Okay. And I think I did write about that in one of my articles back in 2020. It was on my LinkedIn. I'll probably post that article sometime for free. It'll definitely be posted for free when we update the new website. All the articles I've ever written will go on there. Some articles were internally written articles for the company, and then some were public on LinkedIn. So I'll probably just ask for permission to upload all the articles ever. And that will be interesting. But anyways, I hope I explained well that. I hope I explained this well. Again, if you guys have any questions on harmonic average, any of this crazy mumbo jumbo math, yes. Or you can comment down below. What do you agree? Do you agree that the harmonic average is the right way to go? Do you think the weighted average is the right way to go? Do you think the finance industry is kind of insane for pushing the harmonic average? Leave your thoughts down below on that kind of stuff, guys. All right, guys. With that being said, I hope you guys enjoy this conceptual video. I know it might have been a little tough here and there, but I hope I enjoyed making videos like this too, on top of the stock requests. And then there'll be more like this. I'll even do sector analysis going forward. I saw a lot of requests for that. So I think the first sector analysis I'll do is either REITs or banks. I'm leaning on REITs, but you guys can also request sectors now. All right, guys. I hope you have a good one. Bye.